Evening, everybody.
Hello, everybody. Welcome, welcome. Get started here in about 30 seconds. We're letting everybody get into the Zoom room. Don is South Carolina. I'm in California, in case you're wondering. And we're going to be talking about all things investing and creating and preserving more wealth with investment real estate and an amazing, amazing company called Dlp Capital. And so we welcome everybody here, and we are excited to get started here in about 30 seconds. So, Don, how was the rest of your Hawaii trip? Did you snorkel and find any dolphins during that visit?
Um, did not find any dolphins, but yes, I did do some snorkeling with the kids. I had a great time. Spent over 2 weeks out in Hawaii, and I'm actually now though I get back to my home in Asheville, North Carolina. So I'm in North Carolina right now. If anybody's ever been here, the mountains, the only place kind of east of Colorado with real mountains on the East Coast. But yeah, it was an amazing trip to Hawaii, my first time.
So Asheville, North Carolina, is home for you now, is what you're saying. So,
Home
who
in the
you
summertime. Yeah,
home in the summertime?
I live in St. Augustine, Florida.
So
Yeah,
that means you'll need to claim a team, right? So are you looking at, is it the Dukies, or is it NC State? Is it
Tar
North?
Heels for sure.
It's
Yeah,
Tar Heels for sure. Okay, all
yeah.
right, all right, all right. So we'll keep that in mind. Keep that in mind. So I'm a huge Coach K Duke fan. So we have a little bit of odds there. They do say that's maybe the greatest like rivalry, right? I don't know if you
Yeah, for
saw the
sure.
the recent documentary with Duke, North Carolina. They
I
go, I
haven't.
think it's like ESPN special, like, and it was like I was, that's one of my favorite things. So very cool. Well, welcome everybody. We're going to get started right now. For those who are here, we're really passionate about helping people create and preserve more wealth. Our listeners for the first time, where we invest in commercial real estate and other asset types as well, but especially value add, multifamily places where you can get some forced appreciation, you get some depreciation, you get some tax flow, right? Tax flow, because it's not just about cash flow, right? Cash flow is important, but also as the environment changes and they have very high debt, the government that is, taxes increase, and as well as the stock market, some uncertainty quite a bit. Cryptocurrency has crashed. It's more and more important to get back to the fundamentals of investing, and we believe here at Capital Gains Tax System that has to do with multifamily, especially, or mobile home park or senior housing assisted living facilities for a number of reasons. But I'm more than honored and thrilled to have Don Winter with us today. And for those who don't know, Don, he's the founder and CEO of Dlp Capital, and that's a private real estate investment and financial services company focused on making an impact by acquiring, developing, and building relationships, housing leaders, and organizations. And part of what attracted me to Dlp Capital versus some of these other strategic alliances that I have, which are great as well, or even those that are a little bit newer, is the entire kind of value system as well as the machine of Dlp and how rapidly they've grown and built a team to serve at a very high level. And in fact, as a part of that, they have an expansive array of business divisions, including lending, investment funds, sales, leasing, property management, construction management, development, and loan servicing. And that creates an opportunity, kind of like an Amazon, I say. If you can do ownership, if you can do lending, if you can do construction, if you can have all facets, you kind of get vertically integrated. And as that happens, you can create even more scale and hopefully give even a better profit to investors. And so that's part of what DLP is about. Also, their purpose is to dream, live, and prosper, if you're wondering what DLP stands for. But I'm going to let Don Winter come to the stage here. In fact, just a little bit more about Don. He's a part of and has built DLP, and it's ranked 5,000 fastest growing companies in the U.S. In a remarkable 9 consecutive years, this has happened. And since DLP's founding in 2006, Don has closed more than 20,000 real estate transactions, totaling more than $6 billion. And he has built a successful track record of generating consistent profits in all market conditions and cycles. So, Don, that being said, welcome to the webinar. Give us a little bit more about your story. Let's go back a little bit, Don. We'll talk about business here in a minute, but I think it's important to hear about a little bit Don growing up, who you were, how you've come about to have a passion for what you do. So could you give us a little bit about your story, Don?
Thank you, Brett. Appreciate the kind intro. Yeah, I'd love to. And as we were kind of chatting, as people were jumping on, I'm in Asheville, North Carolina today, and live in St. Augustine as my St. Augustine, Florida is my primary home, but I started the organization and grew up in Pennsylvania, Bethlehem, Pennsylvania, specifically, which is, for those not familiar, about an hour north of Philly. We were talking UNC and Duke a moment ago. Bethlehem's known for is Lehigh University. That's the big kind of college in our hometown. And so grew up there, grew up to two young parents who had me at 16 years old. Mom ran a home daycare in my childhood, 6 children in the home, plus me as the oldest of 5 in my home all the time. And my dad was a prison guard. Grew up from humble beginnings, learned, hard work, and also grew up in the church with a strong belief in the Lord that's guided me since. And I went to college at Drexel in Philadelphia, thinking I was going into finance. Sort of stumbled into real estate in college, and kind of took off really, really quick. So October 2006 was the peak of the last real estate cycle. That's when I got my real estate license that month. And my marketing message, your home sold guaranteed or I'll buy it. And basically I help people in a kind of a tough market cycle be able to sell their home, and we either help them sell it or we'd step in and buy it. And that started our investment career. And it's been, as you said, a 16, 17 year journey since, with some pretty great experience, be able to impact a lot of lives. And so that's kind of how it all started. Today, I'm the father of 3 boys myself, 10, 9, and 10 months old, who we adopted at 9 days old, and have a great life. I get to be a coach of flag football and basketball and soccer, and a lot of fun being the dad of 3 boys. And we spent a lot of our summers here in Nashville, and just got back from a great trip to Hawaii with the family, our family BHAG. And we try to do the same thing we do in our business, which I'm sure we'll get to. We try to take the same intention in our family, and our family big, hairy, audacious goal right now is to have 1,000 extraordinary days in 100 different places. So we do a good amount of traveling as a family, getting new experiences. My wife has done the hard work of committing to cyber school my kids. So it's a lot of fun. So happy to dig any deeper there, Rep.
No, Don, that's incredible. I absolutely love the background. I love the humble beginnings. I love the intention. And before we dive into to the investments and everything else, I also think it's important to take even one other kind of step back. Go back to high school days, right? And I believe we've all been given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. Some people call them strengths, some people call them superpowers. But I'm curious, what are those 1 or 2 gifts that you believe you were given, and then how does that help how you help and bless people today?
So that's an interesting and really, really good question. So to go back to high school, I kind of skipped those details quick, but I was about as humbly confident, maybe not as humble as today when I was 16, 17 years old now, but I was as confident kind of in my ability to figure things out. So I've always had the belief that if somebody else could do something, so can I. And so even as a teenager, I was very confident and pig-headed, I guess you'd say, and thought I knew better than my parents. And so I moved out of my parents' house as a junior in high school, and supported my way through high school and into college completely on my own, of course with the Lord, but completely on my own in terms of family support. And I think in the very beginning age, having extreme level of conviction and confidence and the ability to succeed, and the belief in, today I know, now I use the term growth mindset. I always had a belief that I was willing to work hard enough and be humble enough to ask questions and learn. I could learn and do anything. And so, when I got into real estate, I was very confident. The real estate brokerage industry has more professionals in that business than any other profession in the world. 1.2 million real estate agents in America alone, right? And so what's great about that is with 1.2 million agents, there's at least a few hundred that know what they're doing, right? And we're doing it really well. And so it was easy to find people who knew what they were doing and simply follow what they were doing. So I knew if there were other people who could do it successful, why couldn't I? And I was willing to go learn and ask questions and give first. And And so that confidence, I say, it would be, a big part of it in the beginning days, that helped. And then the belief that all businesses, I learned early on, all businesses have one singular purpose, which is to create solutions. So I just always had an approach that if I could figure out a solution for somebody's problem, that I'd be able to produce a living and build a business that had value. And so took that approach from a very beginning age and beginning of my career and what's one of our core values today, of innovative, solution focused, of approaching a problem and with a mindset there has to be a solution. And I'd say the third thing I learned very early on in my career that's benefited me. A lot of people, start their careers and they're afraid, especially when they start businesses, to hire. They're afraid to take on risk and grow. And I was only in real estate for about a month before I hired my first team member, my first assistant, hired the second a few weeks later. Her name's Cindy. She's still with me to this day, 16 years later. And so I was willing to hire and bring in talent and bring in skills and ability that I didn't possess, so I could focus on what I could bring the most value in.
Amazing. I'm going to just kind of encapsulate that. So a deep conviction and belief in the ability to succeed. And if you can see someone else doing it, you can learn, ask great questions, absorb that and make it happen. Number two, asking great questions and being humble enough to learn from others that have already succeeded. And then understanding that every business has a singular purpose, which is to create a solution. And if you could do that, you'll be able to succeed. And the last but not least, not being afraid to hire and take on risks, to delegate, give up control, and expand, which leads into part of, $3 billion under management. And I know some people, I think I introduced a couple clients to, and they're like, how old is that guy? You know what I mean? He's accomplished a lot at a young age. And so I think that speaks to partly why when you kind of went on your own at a young age, right? You got started perhaps earlier than most of thinking and being intentional about these things. And now it's helped you to grow. But what would you say has been the single biggest way that you've been able to grow on the Inc. 5000 list 9 consecutive years in a row?
That's a big question. So I'll just take one quick step back there. So one of the things I didn't say that, I attribute, not just, the success we've had, but success in life. So I always have been saying this for a lot of years, that what separates the most successful people in the world, and whatever way you want to find that, not just business, and everybody else, is grit, which is passion and perseverance towards long-term goals. Or the other definition of grit that I like is talent times effort equals skill times effort equals result. So effort counts twice. Great book by Angela Duckworth. And, I've had the pleasure of being a part of groups like Tiger 21 and other organizations where I've been able to meet really, really successful people and learn their stories. And what I've always found is that I've met people in the most boring to us, and people are not in that industry, the most boring industries, right? But you could just tell they became incredibly successful because they had this incredible passion about what they do. And because they had that incredible passion and obsession with being the best at what they do, they built this level of expertise around their craft that they could do it better than anybody else. And so I, as you said, had that benefit of very early on coming to the conclusion that investing in housing and growing a business around real estate was where my passion was. So, it seems relatively engaged, but this is year 17 now. Been very focused on this for a very consistent period of time now. So one of the things that I recently did a couple of speeches around, or what I call the 5 keys to success, significance, and happiness. And they are having clear purpose, or actually starts with intentionality. And you actually used that word a moment ago. So having incredible amount of intention around the business and around life, what I want to accomplish, which ties into number 2, purpose. 3, having very, very clear goals. 4, grit. And 5, term I mentioned a moment ago, growth mindset. So I believe intentionality, purpose, goals, grit, and growth mindset is the formula to achieve a life of success, significance, and fulfillment. And we teach that to our team members and those we work with. And that focus on intentionally building a great organization led to us about 10 years ago, really realizing that. So like probably many of you, I mean, you're on a podcast, depending on where you're located, late in the evening, right? You have a desire to learn and grow and get better. And I had that desire from early age, and I consumed a lot of books. I still to this day average about 3 books a week. that I complete, and I'm out learning. And you listen to one guru who tells you, leadership is the key to building a great business, right? Another guru tells you, if you just get great at marketing, right, that's the key to building a great business. Another tells you just need to get great at checklists or operations. If you just got great at hiring, right? And all of these experts are experts in their lane, and generally speaking, their advice is great, and what they're experts in is great, but it's one piece to the puzzle. And what I learned early on is that a business has, as we like to think about it, 4 quadrants, which are strategy, people, operations, and acceleration. And I realized I need to be able to grow those 4 quadrants together, a part of one plan, in order to get not only great results, but consistent results year over year, month over month, et cetera. And so about 10 years ago, we built an operating system that we run our organization on, which we call the Elite Execution System. I wrote a book on this a couple of years ago now called Building an Elite Organization. And it's the system we built to be able to consistently and steadily grow our organization. As you said, this is actually our 10th year in a row on the Inc. 5000 list. We've grown between 325% to 500% any 3 years you pick for the last 17 years. We've 10x'd every 5 years for the past 17 years. And not only do we run this system, but this is the same operating system that we help our borrowers and our partners that we invest money with implement into their business as well. So we have a whole community of real estate developers, builders, operators that we partner with and lend to, who also run the same operating system to get consistent, scalable results.
Right, and it really stuck out to me because it was, as I was doing my research and I was getting to know you guys, I met some of your team members at the Best Ever Conference with Joe Fairless, and had a chance to speak there, and you guys were speaking, and I was like, oh, this is cool, I got to meet these other speakers, and had never heard of you before, and then got to know Larry some more as well, he's an amazing team member of yours. And the more I dug in, the more I could see that this is more than just a multifamily investment company, right? And I've been in real estate my entire life, and I'm going, they are serving on another level, and they're leading the way by helping others build their business. And they're leading with values, and they have the performance and the track record. And it's like you said, it's a puzzle piece, and it's not just the one or the other, but it's having them all come together. So I think what I've seen, it's been remarkable, and the stats speak for themselves. And so I think that's where we should transition now to start talking about these investments. But it's so important to establish that foundation, which I think we just did. And I'm going to check out the book for sure, Elite Execution System. So let's transition to that, Don. So what would you say is kind of the biggest secret to consistent, investing performance with you guys, and maybe also break down a little bit of the different things that you offer, and then we'll kind of deep dive on each one.
Yeah, thank you. And when I started managing capital for others, about 12, 13 years ago now, I would sit down with people, and of course, at that point in time, I was in my mid 20s and had no track record, and so that didn't help. But also, when I'd sit down with people, 12 years ago or so, and I would tell them, hey, we're investing in housing, right? We're investing in multifamily housing. People would think, oh, that doesn't sound like a good strategy, right? Who wants to own apartments in North Carolina? That sounds terrible, right? I'd rather buy this nice office building in New Jersey, right? And, I grew up in Pennsylvania. So that's a safe investment, right? So 12 years ago, I needed to convince people that housing or multifamily was a great strategy. Probably, I don't know, other than my team members who are on this meeting with us, I don't think I know anybody else in this call, but I would just guess that I probably don't have to convince many, if anybody, listening to this, that multifamily is a good place to invest now, right? Or workforce housing, which specifically is what we invest in, is a good strategy, right? That was proven through the last cycle. It's been proven through COVID. It's going to be proven again here that even in recessionary times is the best asset class to be in. So I think fundamentally the first thing we've done that's helped us to generate great returns to our investors is we're invested in a great strategy, right? A great place to invest, a place where fundamentally what drives almost everything is we have much greater demand than we have supply. And that's not going to change anytime soon. But the second thing that matters, so if you believe, and I can certainly go into explaining why housing is such a great investment strategy, but if you put that aside and you say, all right, housing is a great investment strategy, but there's a lot of people who you could go invest with in multifamily or in housing, and we do both investing in multifamily plus lending, which we'll talk about. But I always think what matters most is if you determine that the strategy makes sense, is management. And so to me, that whether you're investing in a public stock or you're investing in a private, real estate operator, there's two things that matter. The strategy, does the strategy make sense for the terms and goals of your investment, right? And is the management great, right? And I believe when you're in volatile times like we're in and heading into, management becomes even more important. And in really tough times, the best management teams, right? The best leadership teams not only tend to do well, but they tend to dramatically outperform, average management teams, and not only generate returns, but generate outsized returns and grow their market share and so forth. So I always tell people, this, when times are volatile and when you're concerned about over the investment, you need to be able to look in the eyes of the people you're actually entrusting to execute and make the best decisions. And that's a big part of it, being able to make decisions when things are not clear and be confident. Are they going to be able to manage through, volatility and challenges and change and difficulty, and guide their team, and in turn shepherd and your capital. And so that's what I believe. And that's the elite execution system I talked about. We've built this track record of 60% growth for 17 straight years. Last year, we were the fourth fastest growing company in America that made the Inc. 5000 list 5 or more times. We're now on the list 10 years in a row. That almost never, ever happens. I don't know if it actually has happened. I'm waiting for that final reporting to come out. But that's nothing. The important thing is that it's consistent, right? We've done that through multiple cycles. Our business has grown. We've built the discipline, we call the 20-mile march, the discipline execution of our investment strategy. So that's what we've done really well. And the consistency in how we've run our business has played out into the exact same consistency in the returns that we pay to our investors. So in a dozen years now, we've managed 10 investment funds. And we've generated and exceeded the fund's return targets every single period in every single fund. We've hit our preferred returns to our investors every single period in every single fund. We've exceeded the return expectations in every single period in every single fund. So today we're actively managing 6 funds, ranging from $100 million up to over $1 billion funds, and consistently exceeding return targets, double digits in every period in every fund.
Excellent. Amazing. I mean, it just speaks for itself on that track record. And thank you for sharing that. So let's dive right into, I think, the lending fund. I mean, because one of the ones I think it's most attractive right now, there's a lot of multifamily syndication companies, but a lot of them have just a illiquid asset, right? And, 3 to 5 years, maybe even longer. Even if you look at Delaware statutory trusts and the way they structure those are typically 7 to 10 years, not a lot of value add. And there's folks that are, concerned with the stock market. They want to be, but they don't also want to sit in the bank, but they want some form of some liquidity, right? But also some return. And to be able to return, I believe one of the funds that is pretty attractive has not paid below 10%. So would you just talk about a little bit of the lending fund itself, the performance, but then even more important, the security, or the, how safe do you feel those funds are that you're lending out, and just talk about that a little bit if you could.
Yeah, I'd love to. And one of the big things we focused on, and which is uncommon in private investment offerings, is, as you just said, liquidity, and you controlling the liquidity as the investor. So our lending strategy and our main fund there is called the Dlp Lending Fund. We've been running this fund now since 2014, 8+ years. We've generated double-digit annualized returns every single month for 8 years, 13% average return over the past 8 years. But what's really cool about the funds, the returns are we think, really, really good. And I'll talk about the risk in just a minute, but what's really exciting, I think, about the fund is, so we pay out 2 distributions every single month. So we actually pay out the preferred return, which is 8% annual return, on the first of every single month. And then once we close out the books of the fund in the middle of each month, we pay out a second distribution of everything we earned above the preferred return. So 2 cash distributions, you can let it reinvest, but 2 distributions every single month. And then in addition to that, it's 90-day liquidity. So you could invest today with us, and in 3 weeks, we'll go with a positive angle, the greatest investment opportunity of your life comes along and you want that money out, you can give us notice. There's no lockup, there's no waiting period and redeem out. And at worst, from a practical standpoint, 90 days. So very, very liquid for private offering. Dig more into that. But fundamentally, how we're able to be so liquid and what we fundamentally do is we make short-term loans to professional full-time real estate investors. So we're a short-term bridge lending business. So our average loan pays off in about 10 months. And these are loans to people to build single family homes, to buy and renovate single family homes, to buy and improve multifamily communities, to build multifamily communities. Those are the main strategies. So investing in improving or building housing. And our average borrower, not our average investor investing in our fund, the average person we lend money to has over $4 million in net worth, has 700 credit score, has over $500,000 of cash, liquidity, and have done more than 50 real estate investments. In addition, on average, they have 20 to 30 full-time employees, have a $100 million plus balance sheet. So these are professional, full-time bankable investors that we're lending money to and helping them grow their business. As I talked a bit about earlier, our average loan to value right now and across the last 8 years, right now it's I think 54%. It's been 51 to 57% over the last 8 years. So low leverage, first position loans to professional full-time investors. We've written thousands of loans. We've originated and funded thousands of loans now. We have not written off $1, meaning we haven't lost $1 of principal or interest on a single loan. And we've generated double-digit returns for investors every month now for 8 straight years with liquidity.
Yeah, that's the Hall of Fame track record. That is incredible. Let me ask you about the average LTV on these deals, and always taking first positions, right? Maybe not allowing the seconds. And for anyone that maybe never had paid or didn't pay, what's been the outcome on those?
Yeah, so to give that a little bit more clarity, I guess. So right now, the lending fund has about, these are rough numbers, I don't have the exact for me, but has about $700 million out right now, backed by, doing the rough math, $1.3 billion of real estate, right? So there's $600 million of equity behind our loans. So that's a big deal. Individually, it's a lot per loan, but then when you look at that across the spectrum, the amount of security we have behind our loans. So even if you listen to the news and you believe, which I don't think is accurate today, but even if it was accurate, that property values are on the decline or home prices are going to go down a little bit, we think about that, we have, on average 45% equity behind our loan. And so what happens when somebody doesn't make their payments? And of course that does happen. If any lender who tells you every borrower makes their payment every single month hasn't done enough loans. So for sure, you're going to have borrowers who don't make payments, who go into delinquency or default. Generally speaking, they get tight on cash. They had a big sale of a property coming and it gets delayed, or the deal falls apart and they get tight on cash. So that does happen. Right now, we have less than 1% of our loans that are delinquent. We have since COVID, but it does happen. So typically speaking, they get delinquent. We work with them. We communicate with them. They have some form of liquidity event. They sell a property or get something done and they get current. Every now and then that doesn't happen, and we have to take legal action and pursue, taking possession of the asset or some sort of workout strategy. So we've had to do that over the years, but never to the point that we were at jeopardy of losing principal or even writing off interest due by the borrowers. And so we've had a number, and I can get into the weeds on it, but a number of cases we've had to work out loans. Sometimes we've been able to turn a property over to another borrower to purchase and take it over. But we've done a lot of creative things, bringing in a contractor, doing different things to finish properties. And that's one of the unique things with us. In addition to being a lender against single family and multifamily properties, value add and new build, we do all of that as a sponsor, as an operator as well. So there's nothing we lend on that we don't do directly as well. So we have a deep level of expertise that if we had to step in, if we had to take ownership of the property, if we had to complete the project, we do it every day. So people think, well, what happens if a bunch of borrowers go delinquent? Well, as I mentioned a moment ago, in this fund, we have, $1 billion plus of real estate that we have loans against. This past year, we've bought $1.2, $1.3 billion of real estate as a buyer, as an owner, right? So us having to buy a property or take over some loans that go default, that's a tiny, fraction of what we're already acquiring every day right now in distress and default situations, not where we're the lender, but where we're stepping in as buyers. So it's something we're capable and do every day, of stepping into situations and completing business plans and finishing properties.
Excellent. So the 1.3 billion in the asset value, 700 million in loans, basically, about a 50, I think a 50%, 3% LTV there. So the value, let's say it was $1 million property, would need to kind of drop to about $500,000, right? And the odds of that happening, who knows, but it's low probability that's going to happen before you guys start really to lose there, is what I'm hearing. As well, you've had under less than a 1% delinquent rate. And a question that came up from one of the deferred sales trust clients is, what interest rate do you lend to these borrowers on average?
Yeah.
Right. And how does that look in this environment, which rising interest rates, right, in returns, kind of give us a feel for that overall numbers there?
Yeah. Wonderful question. So our average interest rate today across all our loans is, and again, it might not be exact, but right now it's about 9.3%. So you might be thinking, well, how do you lend money out at 9.3% and pay investors double digits, right? So two things that help us generate higher returns than our interest rate. One is we charge what we fondly call Dutch interest. So if you're not familiar with that term, what it means is, let's say you came to us today and to buy a property. You were an investor, you were buying a property. I'll use your example. You're buying a property, it's worth $1 million, and we're lending you $550,000. Okay. Well, let's say that property needs $100,000 worth of improvements, construction, right? So if we gave you a $550,000 loan and that property had $100,000 of construction to complete, we wouldn't give you that $100,000 today. We would only give you $450,000, and we would fund the $100,000 as you complete the work. We actually go out and inspect the work, verify it was done and paid, and we release the money to you in draws. Well, even though I haven't funded you that $100,000, I charge you interest on it anyway. So we charge interest on our unfunded rehab holdback. So that term we call Dutch interest gives us an effective interest rate of about 10.5, 11%. And then how our returns get a little bit higher from there is we use warehouse facilities from banks to give us a modest amount of leverage on the fund. So in that same example, if I funded a borrower a loan for $550,000 against a property worth $1 million, I may borrow, say, $250,000 of my loan from a bank at a cost of 4.5%. So that leverage gives me a spread on that money that increases our return and also helps us with cash management and some other things as well. So that helps us get to an effective yield of about 15, 16%. And that's what's allowed us historically to pay our investors on average 13% over the last 8 years, and we still earn our management fee and a little bit of profit as well.
That is that's brilliant. I think of it like in a Rubik's cube, right? And you guys are there like solving problems and the different colors, and you're like, well, if you move this like this, and if you move it like this, and if we get 4.5% for $250,000 from this bank, and if we hold back this $100,000 and still charge them on it, and we put these things together, we're able to deliver that. So now to finish the question, interest rates are going higher. Do you anticipate that return being higher now that maybe the expectation of the borrower is, well, I was getting 9.3% before interest rates? I mean, even today, right? Or yesterday, it was announced that another increase in interest rates. And then I also want you to pivot that into the inflation discussion here and how that applies to multifamily investment funds that you have.
Yeah, thank you. So, our most direct competitor for the lending we do are banks and, called traditional lenders, right? And exciting things is the last time we spoke, Brett, is we actually on Thursday of last week, so I guess a week now, we got approval to buy the bank we're buying. So I'm actually buying a bank, and we'll be closing on September 15th, and we'll own a community bank. So I like banking, and it's a building we're pretty excited about. But historically speaking, probably nobody's going to be surprised when I say dealing with banks tends to be tough, difficult, slow, painful. So people, generally speaking, have to evaluate paying us 9%, say, versus what they can borrow from a bank or a traditional source. And that spread is kind of the friction cost, right? How much am I willing to kind of pay to work with a lender who's going to be easy to work with, move fast, give me surety of execution, et cetera. So for us, as interest rates go up on the banking side or the traditional lender source, not just banks, but traditional kind of institutional sources of capital, that benefits us because they'd rather work with us. But if the savings is too big, right, they'll deal with the headaches, right? Is kind of what some borrowers make the decision. So far, since all the rate hikes have happened, we've only increased our rates modestly. But we're certainly, if they continue, we'll be in a great position to be able to increase our yield. So in short, kind of the second part of your question, as a short-term bridge lender, meaning we don't make any loans where we're locking in our interest rate long-term. Interest rates going up is a benefit to us, right? We're an interest rate hedge in that if rates were 8-9% right now on the banking side, yeah, we'd be charging 13-14%, right? So interest rates going up benefits you when you're a short-term lender, right? We're not like a lot of banks who have a balance sheet right now of 30-year mortgages at 4%, where this is a really big negative that rates are going up because I have effectively negative returns on my books, right? We don't have any loans on our balance sheet that our rates locked in longer than 12 months. So we can increase our rates across our balance sheet as rates go up. So for us, interest rates going up is a benefit. It's a great, hedge against kind of the concern of rates going up. And then
Makes perfect sense. Yeah, you want to dive into the transition of the multifamily funding now and like how that fits in with inflation and how multifamily is, I think it's at 5 to 7 million units that we're still short, right? And just maybe give it a little bit overview of DLP's multifamily funds.
Yeah. So one half of our world is making loans to other real estate investors who are investing in housing, workforce housing, right? That's half our business. We're investing in the same properties as a lender as we're investing in as an owner. So the other side of our business is we run funds focused on buying and improving or building new workforce affordable housing. And as you said, the stats are all over, but the stat I most recently saw is that we're right now short 5.3 million housing units in America. That demand and that is greater in the Sun Belt region, probably not a surprise to anybody, which is where we do most of our investing, that's where population and job growth is happening, Texas, Florida, Carolinas, et cetera. That's where we do most of our investing. The issues in today's market that people are concerned about, such as inflation, real estate in general, but certainly housing is a great inflation hedge, right? Inflation is a good thing for real estate, generally speaking. I get there's some unique variables going on right now that we could dig into, but generally speaking, real estate is a great inflation hedge. So what we do, our strategy is to invest in either building brand new or buying existing housing, we self-mandate ourselves that we're impact investors. So all of our funds are impact funds, and we self-mandate ourselves that at least 85% of all of our investments make a positive impact on the workforce housing crisis we have in America. And how we mandate ourselves to do that is under one specific metric is that we put most of our focus on, which is that our average cost of housing or the rents for our housing that we own, the rents are less than 30% of the area median income. So generally accepted kind of rule of thumb is if somebody's paying less than 30% of their income on rent, that's considered affordable. When they start spending more than 30% of their income on rent, they become what kind of the industry term used as cost burden, right? They're struggling to make ends meet when 35, 40% of their income, their gross income is going out just to pay the rent. And then about a third of renters today are spending more than 50% of their income on rent, which is not, it doesn't work, right? You can't have half your income just paying rent. Then you don't have enough money to pay for the basics of healthcare, food, education, et cetera, right? So our average across our portfolio today is about 20%. So about 20% of their income is going around, which is generally very affordable. That doesn't mean we're investing in, kind of low end Class C housing. Our average apartment or home we own today was built in the early 2000s. So generally speaking, they're nice communities that are affordable for people to live and work in the same place. And that's the focus, where they can live where they work, right? Where they're not having a poor quality of life because they have to travel an hour outside of town to find a place that they can afford to live. So that's what we focus on doing. Our average rent in our portfolio today is about $1,000, a hair over. We own in our equity funds 16, 17,000 rental homes today. That's multifamily and single family. We're actively building thousands of brand new workforce housing units, mainly in Texas and Florida and a bit in the Carolinas. And we run two main funds that invest in this. One is called the Dlp Housing Fund, which invests in existing rental communities. And then we call the Building Community Fund, which invests in building new communities. And that's what we do. And we're fully vertically integrated, as you said, executing across the whole sort of value chain. And the great thing on this side of our business, owning real estate, is it's incredibly tax efficient. So last year, if I wanted just to, I guess, sell everybody in this meeting to invest with me, I would have led with the fact that, but I say this cautiously and because I don't like to set this expectation, but last year we generated 45.57% net returns to our investors, 45.57% annual net return to our investors last year in the Dlp Housing Fund. And we did that with a taxable loss, right? So if you invested $1 million with us, we returned to you last year $457,000 with no taxable income, right? So incredibly tax efficient, great returns over our housing fund. Since we launched it 3 years ago, we're at about 30%, a hair under 30% net to investors over the past 3 years. The target is 10 to 12%, but like every other one of our funds, we've always exceeded our return target. So I wouldn't tell you to invest with us on the owning of housing side, expecting 45% returns or expecting 30% returns. But we've always generated very, very, very solid, high double-digit returns, with being extremely tax efficient. And then kind of the final big selling point to how we're structured is, unlike most real estate direct investments or syndications or even other funds, one of the tough things, and you kind of hit on it earlier, is if I ran a typical real estate fund, typical multifamily fund or syndication, you invest your money with me, your money is basically stuck in that investment for as long as I say so. And I'm slightly being facetious, but that's really how it works, right? You can't take your money out until I decide to sell that property, right? So it might be set up, it's a 5 to 7 year investment, but then generally speaking, I'll have options that I can extend that out if I need to. And so really your money is kind of stuck, if not forever, for at least the next 5, 7, 8 years. And that's really tough for you, but it's also not ideal for me. Because what happens for a lot of people, and this is some of the best buying opportunities we get, a lot of times fund managers now are in the end of their fund or the end of their investment, and they have to sell the property because investors are demanding their money back, and it might not be the best time to sell, right? So I'm stuck having to sell a property when I might not want to sell, right? And you're stuck getting a big return and a big taxable problem potentially. Of course, Brett can solve that for you, but potentially a big taxable problem at what not might be a good time for you. But on the other side, if you need that money sooner, you can't get access to it. So on our housing funds, we give our investors the ability to redeem part or all of their investment, their choice, every year. So we have a redemption window from February to March every year where you can redeem out of the fund. So you get to choose when you're going to take that liquidity event and when potentially you're going to have a taxable event. So you're not having to make a long-term commitment. And then for me, I don't have any timeline that I need to wind down that fund at the wrong time. So let's just pretend in the next year, property values really do drop a good amount. Well, guess what that means for us? We're not selling anything, right? And we're buying a whole lot, right? Because we run evergreen open-ended funds. We're going to be able to generate great cash flow. We're very confident about that. Even in a recession environment, the demand for $1,000 apartments is not going down. Actually, it'll go up when there's a recession environment. So we'll generate great cash flow. We'll buy properties at lower prices, and we won't sell. But we have that flexibility to do that because our funds are evergreen. We're going to keep running this strategy for decades from now, we suspect. But you have the ability to have liquidity when you need it or want it.
That is phenomenal and really just a great overview. Thank you so much for that. What questions haven't I asked so far, Don, that I should be asking?
How do I invest? No, I'm just teasing. But in all seriousness, one of the things that people like to do, obviously, thank you for joining, watching this live recorded. It's, trying to give some insights in color, but obviously there's questions that we won't get to here that may apply specific to your situations, your goals, or just want to dig in and do more homework and say, all right, this guy sounds like, you're talking about, but let me see if this is, real or whatnot. So one of the things that we do, and we're not certainly alone in this, is we have a phenomenal investor portal that we can circle around, where you can log in, see all the historical track record on all our funds, all of our detailed reporting. We do full reporting out to our investors every month. We do full quarterly reporting on the organization. We're people invest with us. Certainly they get attracted by the returns. But they stay with us, I think, even more so due to the communication and transparency we provide. And that's why even when we have our most volatile times, when the people are having the most fear, like March of 2020, are always the biggest capital raising times for us. We bring in lots of people come to us because they feel confident in our ability to navigate tough times and our ability to be transparent with what's going on. So we can give you access to our investor portal, where you can see every fund has audits, full details. And it looks like my associate Larry, who runs all of our investor relations, just dropped kind of that information in chat. But yeah, that would be one item. But I think you covered a wide range. But happy, Brett, to dig into anything you think we didn't cover.
I think this is great so far. And by the way, people, you can go to, everyone listening, dlpcapital.com. That's dlpcapital.com. If you're listening to this on the podcast or on a replay, that's dlpcapital.com. I want to open it up for everyone to ask any questions whatsoever for myself regarding the deferred sales trust and or Don regarding DLP. And you can either put it in the chat, and you can unmute yourself and ask away. This is your opportunity. We're going to spend the last 10 to 15 minutes just kind of going and answering questions. So who has a question, go ahead and put it in the chat and or raise your hand or unmute yourself, and we can ask away.
Awesome. As you do that, I'll just throw out, if you go to dlpcapital.com, at the top, there's a little button that says Investor Portal. And you click that, that's where you can register in 2 minutes and have access to everything I said, and see and review all of our funds and documents and audits and reporting and so forth.
Excellent. Does anybody have a question? Everyone's on mute, it looks like, which is fine, no problem. I can ask some questions. I can keep going for some more, but as it comes to you guys, feel free to unmute yourself and say hello. Let's talk about a little bit of there's some different lending funds, right? So there's not just one, there's multiple ones, right, Don?
Yes.
And so can you tell us just a little bit of the nuance between why someone might go into, the one that's been averaging 13% versus maybe going to one of the other ones?
Yeah, thanks, Brett. It can be, first time, especially just listening kind of without kind of looking at materials, it seemed like a lot. We run 5 total investment funds that are available today. The 2 I mentioned on the equity side, one kind of simple there, one that owns existing housing and one that builds new housing. That's kind of the simple determination. But then we run 3 strategies on the lending side of our business. The Dlp Lending Fund is what I've talked about, that we've been running for 8 years. And then we have 2 other offerings. One is called the Dlp Positive Note Fund, and it's worth mentioning. It's very different than the rest of our funds in some ways, and the same in others. So it's the same in that it does the same thing. It makes loans backed by housing, basically the same kind of LTVs and same type of same borrowers, et cetera. The one difference, though, is instead of you being an LP in the fund, you're actually a lender to the fund. You're a note holder. So instead of getting equity returns or partner returns that are based on the performance, you're actually a lender to the fund, and you get a fixed return on your investment. So a lot of people think of it as a bond alternative. So we pay out a 5 to a 7.5% fixed return based on how long you choose to invest, and how much you choose to invest. So you choose the simple little scale. And it can be an easy way to going. From most people's perspective, it's the lowest risk because you're getting a guaranteed fixed return by us, monthly distributions, or the ability to let it compound and grow. And that fund, like all of our funds, you can take distributions or let it compound and grow. You can change at any time. All of our funds, you can do qualified money and non-qualified money, IRAs, 401ks. We're on all the big custodial platforms and such as well. And then our other lending strategy fund is called the DLP Preferred Credit Fund. And what's unique about this fund, I believe, in my personal belief, I could easily place the argument that's the lowest risk profile of any of our funds. Some may consider it the highest risk profile, and that might seem confusing. But what's unique about this fund is, in addition to doing first position loans, it has the ability and does do second position or subordinate loans. So naturally speaking, we've all sort of are trained who've been around lending that, well, being first position is best, and that's the lowest risk, and that's a fair stance. But what makes this lower risk, in my belief, is that we only will do a second position loan to the highest quality borrowers, only to our biggest and best borrowers. We only do it when there's large amounts of equity. I don't think we have a single loan that doesn't have over $1 million of equity behind us. And to put it in this perspective, we've never had a delinquency in this strategy, right? So generates double-digit returns, and we think it hasn't yet done it because it's a newer fund. It's about a year old. We've been doing this strategy for years. This is the second one of these funds. And we think over time ahead, it will outperform the lending fund by a couple percent, the one that only does first position lending, but double-digit return, same liquidity, et cetera.
Excellent. And how easy to switch in between these different funds that you have? Is it complicated if I want to be more conservative for the next 6 to 12 months, and then I want to move over into a little more aggressive? What does that look like?
Yeah, so it's fairly easy on the lending side of our business. So if you came in any of our lending funds, it's fairly easy because, as talked about a few minutes ago, we have 90-day liquidity there. So if you came along and said, and Larry and team work really hard to make it streamlined for you, meaning if you say you came in our lending fund, you said, this is great, I'm getting double-digit returns, but I keep seeing those, tax efficient 45% returns you generate in the housing fund. I want to go move over there. Larry and team will work with you to not only transition the money, but transition it where there's no limited or no downtime, where your money's not sitting, not earning anything. And it's easy to do it on the lending side because of the liquidity. We can do it virtually anytime. If you invest on the real estate ownership side, we can absolutely do it as well. We have to time it around the redemption period, which is middle of February to late April each year. So around that time, when our investor success manager team would touch base with you on your investments, we do quarterly review calls with our investors every quarter, reviewing their investments with us, talking about, what's changed and what might make sense change. And we'd have that conversation. We'd say, yeah, I want to pull some of this money in the housing fund and go into your lending strategy because I want more monthly distributions or whatever the case is. We'll coordinate that timing to help you do so.
Yeah, that's
so fairly easy is the short answer.
Excellent. Well answered. And I was just reading another question here. So there was another one, just monitoring, being able to look at everything online, right? So how easy to monitor everything online if you have multiple investments with you guys, one login, and then as far as switching the investments, it's not something you can just switch online. I would imagine you have to kind of probably fill out paperwork for the new fund, exit the one, but your team will work with each of the in my scenario, a lot of our deferred sales trust clients, myself, and our team to make that as seamless as you can be, right? Is that how that would work, Don? Or how would that
Absolutely.
work?
So it's kind of two-part question. So in terms of access to seeing all the reporting on your accounts and all the tax reporting, and big deal for some of you guys that might be here that I didn't highlight on, which if one of the members of our accounting team were on, they'd really be upset if I hadn't said this already, which is we've gotten all of our tax reporting, our K1s, et cetera, out by deadline across all of our funds, which is uncommon in real estate funds, especially when we're counting on others to produce the property level reporting. So we do a really great job of providing timely reporting, access to all those K1s and signed documents and monthly reporting and all the details on the funds that are access to at any time, all under one login, all viewable. We can have you view all, if you have IRA accounts and cash accounts and accounts in your name and your wives and get, all under one login. We can make it really easy, very streamlined. But in terms of moving money from one account to the other, it's not as certainly not as simple as a public market investment where we have to actually move that money within our funds and time it accordingly. But it's a simple process. You reach out to Larry or Liz, who's our head of operations, has also jumped on here with us, or any of the team members that you work with, and they'll coordinate it all for you. It's generally a couple simple documents, and we coordinate that whole process for you, all the timing, everything.
Perfect. Hey, I want to transition a little bit into the deferred sales trust, right? Because I have a lot of clients that are on here that are deferred sales trust clients, and others are looking at it for the first time. And I want to. I know you're looking at it kind of for the first time too, Don, right? Or you're still getting to know it, and you've had a chance to just scratch the surface. But just curious on your initial just thoughts, feelings, overview. Being that you've been in the business a long time, what's been your take on the deferred sales trust so far?
Yeah, it's really interesting. And remind me, Brett, after this call, if I don't remember myself to it, because I'm going to be doing an introduction to you. So put it this way. So at the event we just had an event here in Asheville, North Carolina this past week for 3 days. We had 100 or so real estate developers and their teams here, spending a few days focused on scaling our businesses. And one of the gentlemen at the event, his name's Michael. He's actually a doctor by training, but also a good real estate investor, And he was talking with me how he's got $40 million right now of LP money, tied up investments with huge capital gains, and trying to work through a strategy to move that money out. And so this just happened a couple of days ago. And so I started talking to him about what you guys do. And I probably can't yet explain it as well, certainly as you can. But he was incredibly interested. And Mike's one of our big investors and big partner of ours. And I'm putting him in touch with you guys to evaluate this for him. I think from what I've heard, it's going to be a perfect situation for him. And that's one of the things that excited us most about how this relationship really started. Is one of the most common things that Larry and I deal with is investors saying, I got all this property I've owned for 20 years, or that's the most common thing for us that we deal with, and I want to sell it, but I've got these huge gains, right? I got no basis, or I've got the proverbial Tesla stock, and all these gains, and I just don't want to pay these gains, and so we haven't had a good solution for it, right? 1031s, is what we all generally do, and that's what we've done a lot of, and but they're difficult and they're hard and to manage. They're hard for us, the manager, to bring them in. If you do a 1031, now you got to be on all the loan documents. You've got to be involved in that whole process. You've got to sign docs all the time. You got to provide your financial to lender all the time. You may have to have some key person risk. It's just a headache for everybody involved. In this strategy, for somebody to be able to execute, whether it's real estate or not, and move their money in with the same kind of tax deferral benefits, but have complete freedom to how they invest. And I mean, it's been amazing. So as you know, I brought in Bob, who's my CFO, who's been 37 years is basically a CFO running large multi-billion-dollar real estate platforms, and was certainly familiar with the tax deferral model, but had never seen this way of doing it, this sort of mastery to it, and has been incredibly intrigued, as was my chief legal counsel, Barry, who was on the call and such as well. So yeah, we're extremely impressed and interested in looking at it for ourselves, but even more so for a number of our clients who have assets outside of real estate as well as in real estate.
Thanks, Don, for sharing. Appreciate that. And if people want to learn more about that, go to capitalgainstaxsolutions.com. We also got the new book coming out with Kevin Harrington from Shark Tank, which will be on this book. And Don, I'd love for you to be in the next book, right? We've got some other commercial real estate syndicators in this, but if you guys want to learn more, I got my whole story coming out. It's going to be on Amazon here soon. I want to look at the chat to see if there's any other questions. If anyone has questions too, you can unmute yourself and say hello. Looks like we have one from Shay. He says, current DLP investor and DLP client. Is there a consideration? He's a deferred sales client of mine. Consideration when applying to DLP for multifamily construction loans that company owners are current investors with DLP. Meaning, does it help to grow with DLP from a business standpoint if already investing in funds? In other words, are you looking for people that are already in the family of investment? And then if they're also, Shay happens to be a multifamily investor and builder as well. Does that help, or what? Kind of walk us through what that looks like for the loan application process?
Yeah, thanks, Shay, and thanks for being an investor. I don't think we've had the pleasure of meeting yet, but that's awesome. And to that point, we have 2,200 families invested with us, and I probably do know 1,500 of them. So you're in the minority that we haven't met yet. And to that point, we're relationship driven. I mean, this event we just did as an example, we had basically all of our top borrowers and partners we lend to invest with here with us, and we do these events, throughout the year. And every lender, every financial service company say they're relationship driven, but almost none are. So for us, we're all about finding ways to deeply add value to our clients' lives. And it's very similar. That gentleman I was just mentioning, Michael, who was given the DST story, he's both one of our members of our operator community, but he's also a significant investor with us. And so certainly it's helpful because we know, that we already work well together. We of course know that you have capital with us already, and that gives us a comfort. Of course, you have a different level of knowledge, understanding to what we do and what returns we need to generate and how we operate, that, you understand why we lend the way we do and what our performance history has been. So yeah, we have many clients who are on both sides of our house, people we're lending to and partnering with and investing in our funds, right? And that's not an uncommon situation. We probably have 50 to 100 people in that situation. So we'd welcome it, and we'd welcome the opportunity to talk to you on the lending, partnering side, the multifamily construction side, and help in any way we can. And not only do we lend, which is our main business, but then we also do all of the takeout financing to provide the best long-term financing on properties too. We don't do that on our balance sheet, but we use our capital markets team to find our partners and our borrowers the very best long-term debt as well. So yes, absolutely.
Got another question. It's a great question. It says, Warren says, we're looking at an investment fund comparison sheet for DLP and notice that there's a row called return split 80-20. Can you explain further?
Yeah, absolutely. So a couple unique things about how we structure our returns. So if you looked at 100 different investment funds, and counting DLP only as one, so it sounds like you're looking at our sheet with all 5, but if you looked at DLP as one, you looked at 99 other fund managers, my guess is not one other fund manager would structure their waterfall of returns the way we do. And what I mean by that is almost every fund manager in existence, they get a management fee on the money before you get any returns. That's how every fund is set up virtually. How our waterfall works is you get a preferred return on your money, depending on the fund, ranging from 6 to 9%. That's what you get before we earn $1. Then we get our management fee. And then the splits are 80-20, meaning you get 80% of the profits and we get 20%. So we get a 20% promote. So all the returns I've been talking about on this conversation are all net to investors after we earned our return. But if you've invested in other funds or look at other funds, our fee structure is 1 to 1.5% management fee, depending on the fund. Industry average is about 2, and we earn a 20% promote. So we're on the lower end of the profit share and the fee side, but it's also after you've gotten a preferred return. So we always put investors first.
Maybe that's great, and maybe you can explain that too. So the overall, let's say you put $1 million into the lending fund,
Yep.
and you said the average is about 13 now. You got to the 13 because that's that extra 80-20 split, right? You had outperformed based upon after you pay the pref, after you pay the management, there was extra, and that's how it's split. So break that down of what it took to get there and how you calculated that.
Yeah. So if we generated, so in the past year, and I'm using rough numbers, but in the past year, and I just like to always set the right expectation. So on our lending strategy, our return target is 9% net to investors. We've never had a single period where we didn't generate double digits. And in the past year, we're, I think, about 12.5 net to investors. So that means to get to 12.5 net to investors, the total return would have been, after all expenses, would have been about 15%. We would have got, 2.5, and investors would have gotten 12.5. So total returns were 15. We earn 2.5%. You earn 12.5.
Perfect. Excellent. Well answered. Looking to see if there's more questions here, and if you have, you can also unmute yourself or put it in the chat. Let's see. I think we're all caught up on the. Let's see. Have you looked into converting office buildings into apartments? I mean, any kind of creative ways to get housing going with either even mobile home parks, or senior housing, or is it mostly just workforce, multifamily, conventional, any low income housing, anything that's creative there for more housing?
Yes, all the above. So yes, we're all about figuring out creative ways to create affordable workforce housing. And office building conversions, or another sort of growing common one, is motel room conversions, So we've done all of that. Specific questions though about office buildings, yes. So most cases, fundamentally it's difficult and it doesn't work in a lot of cases financially. But I have two really good examples right now. So in downtown Jacksonville, which again, if anybody doesn't know where St. Augustine is the oldest city in America, 456 years old, just south of Jacksonville. That's where I call home. And we are doing a lot of work in downtown Jacksonville. But one of the projects we're doing, we bought what used to be the Jacksonville Energy Authority World Headquarters, or I guess local headquarters. It's not a worldwide company, but it's a 19-story office building. At one point, it was the tallest building in Florida. And we're converting that 19-story office building. First floor is going to be a grocer, top floor is a restaurant, and then in between, we're converting to 135 apartments. So that's in construction right now. Another one is our headquarters, our Northeast headquarters in Allentown, Pennsylvania, which we just bought 3 or 4 months ago. We just moved in there as our Pennsylvania headquarters, our Northeast headquarters, is a gorgeous Class AA plus 250,000 square foot, unbelievable office building. We took the 8th floor of the building. It's an 8th floor building, and we're converting floors 2 through 7 right now to housing. So those are a couple examples of doing that. So yes, absolutely. We love mobile. We love RV. We've done a number of different strategies that allow us to create housing.
Fantastic. Looks like there's another question too. I don't know if you can see in the chat, but I'll mention it out loud just in case folks are listening to this on the podcast or driving or they're listening to this. You said it's from he. He says, "Hey Don, you mentioned getting a higher return lending at 9%. What percentage of the lending fund is borrowed, leveraged from an outside bank?"
Yeah, it's a great question, and one that for some people who aren't as familiar with that term, it sounds like person who asked the question's got good knowledge base. So just to frame that a little bit or give a little more insight. So when we lend out money, so right now, as I mentioned a moment ago, we have, call it $1 billion to $1.3 billion worth of real estate. We have $700 million of loans against right now. That's about 700 loans, 600, I think 50. Our average loan in the fund's like 1.2 million, I think right now. And so on average, at that $700 million of capital we have out right now against that $1 billion plus of real estate, a little less than half, so about 300 million out of the 700 million is leverage or borrowed from a bank. So about 400 million is investor equity and about 300 million is leverage. So that means less than 50%. We've always been less than 50% leverage, which most who are in this space would consider that very low leverage. A lot of our quote unquote competitors are leveraged 9 or 10 to 1, meaning if they had $700 million of loans, they would have $630 million worth of leverage against $70 million of equity. That's pretty typical. Most of our banks allow us to leverage anywhere from 3 to 6 to 1, but we've never done this. We've never been more than called a 1-to-1 leveraged equity.
Well answered. Very clear. Thank you. So it looks like it's very low leverage, right? So not.
We consider it low, yeah.
Yep. Yeah, considered low for the industry, right? And so for every 700 million out or so on a $1.3 million, it's about 300 million. So maybe like a 60-40. I don't know if that's a.
Yeah, I mean, that's about where we're at today. But we've always told investors we expect to be somewhere. Actually, the opposite side is kind of what we've kind of always modeled in our fund, is that we'd be 60% leverage and 40% equity. Mm-hmm. We've never gotten that high. But if you think about it from a pure, basic standpoint of real estate, right? If you owned a $1 million piece of real estate, 60% leverage against that, a $600,000 loan would generally be thought of as pretty conservative, right? It's the same essential math at the end of the day.
Yeah. Excellent. Great question. He, thanks for asking that one. Anyone else have any more questions? You can unmute yourself. You can put it in the chat. You can, say hello to Don and I. We've covered some good ground here too. While we're waiting, anything else, Don, that has also come to mind that we should be asking we haven't asked, or any new opportunities or deals, or like what's kind of your overall flavor of the marketplace right now, or temperature, right? With change, what do you anticipate? Do you anticipate opportunities and deals and potential multifamily foreclosures for people who are paying three caps in environments that were, so they already pressed the rents to the tilt, and I mean, some of these deals that have gone down the last couple of years, I scratch my head and say, I don't know what they're going to do. I don't know how they're going to, I don't know how much more value they can add to increase these rents. And so I imagine you guys are very diligent in underwriting and in the deals that you buy. But do you anticipate opportunities to take advantage of maybe perhaps those who like Warren Buffett would say, maybe see who've been skinny dipping because they were too aggressive during this last couple of years?
Yeah, I mean, there's a lot of, and I don't mean to pick on anybody's business model, but there's a lot of people who've gotten into multifamily, who've gotten into real estate, who probably shouldn't have, and even if they did, they probably haven't focused enough on actually building a great business and being able to generate this somewhat important detail called cash flow, right? And a lot of people have been able to survive through appreciation, through refinancing, through selling something when they did no work whatsoever for more money than they paid, because the market's been so good. And so being able to actually execute on your strategy is not easy, right? Dealing with a 300 unit apartment community, that's 700, 800 people living there, right? That's 800 toilets, right? I mean, there's a lot of work that has to get done, and keeping that property 90+%, physically and economically occupied, as everybody models out that they're going to be able to do, is not easy, right? So we believe, and this is why we built this community and why we go and we teach and have these operators come and join us to talk about discipline, right? And I always say, real estate entrepreneurs think of discipline as a 4-letter word. And discipline is the key. So and I could spend a lot of time on this, but we've built our business to be very disciplined and make sure that we're putting in the right foundation. There's a great book. I'm a huge Jim Collins fan, and there's a great book, not his most famous book, but called How the Mighty Fall. And they study the fact that more companies go out of business due to indigestion than starvation, right? And businesses only go out of business for really one reason. They run out of cash, right? And so there's a lot of people who are going to struggle with not being able to operate and generate cash, with not being able to refinance their properties because the financial markets are tight, and they took out heavy leverage, and now they can't get takeout financing. So there's a lot of volatility and a lot of people who are going to sort of be spit out from the market, I believe, which is going to create a lot of excellent buying opportunities. And the great Sam Zell always says, we don't buy markets, you buy deals. So yes, there's market volatility, but it also creates, even more importantly, deal specific situations that create urgency and issues. So, and then on top of that, with what's going on in the stock market, believe it or not, I know everybody says that real estate's uncorrelated, and in some ways it is, but what is directly correlated is most of the money that drives the real estate today is driven off the stock market, and especially on the debt side. So a lot of lenders are out of the market because they can't get access to capital, right? They can't get their securitizations or bonds or CLOs done. And so that creates a lot of opportunity for us as a private lender to be able to lend and lend at lower leverage and better returns. And so all that to summarize and say, we're very active, we're very optimistic, we're very confident in the opportunities that volatility will create. And we're focused on being able to be willing to make decisions and find opportunity when others are afraid and nervous, and kind of as you sort of reference there. So it's going to be a great time for us. We believe we don't want to go into heavy recession, right? For the average man or woman, right? It's not a great thing, but that type of fear that comes from change and volatility, creates a lot of opportunities. We might not be selling a whole lot of things, drop in values, but we'll be active buying. We're very confident in our ability to continue to generate great cash flow, both on the real estate side and in our lending portfolio, where we earn all our income on a monthly basis. It's all current income paid to us on the first of every month. So, so it's going to be a really exciting time, and the best, operators in any business, not just real estate, generally pick up market share and create their most value in the times of volatility. And, we're excited about it. In March of 2020, we went under contract to buy a $1.8 billion real estate portfolio. It would have been one of the largest real estate transactions done in the space. It didn't end up happening when the market kind of calmed down. the group kind of pulled out. And but my point being is it would have been, we would have made $1 billion on that deal already if we would have been able to close, because it was an incredible buy. My point is, we were looking for opportunities to capitalize, and it was a group who actually got kind of destroyed in the energy markets back then, needed liquidity. But we're going to be very active. And that would be my last thing I'd kind of say that I haven't said is Larry and I would painfully joke, I guess you'd say, that 99.99% of investor complaints we get and have gotten over the last 5 years are for one thing. People want us to deploy their money faster. So the only complaint we ever get is, that it took us 45 days or 60 days to fully deploy their money. Because we don't really operate often on a capital call structure. You invest and we deploy your money. And right now, because of all the things going on, we've never had better deal volume. We have over $1 billion worth of deals under agreement right now. We're actively investing. So, if you're interested in getting involved with it right now, we've been deploying people's money in the matter of days, and we believe we'll generate, capitalizing on ability to generate some really, really, great returns. So, phenomenal, opportunity right now to invest, and we're seeing, just tremendous deal volume.
Awesome. By the way, what is the average deployment like on the lending fund? Like, how long would it take, do you think?
I mean, historically, we've averaged 3 weeks. I'd say, probably over the last 6 months, we're probably averaging, less than 10 days. So we're deploying very, very quick because we have, incredible demand.
What percentage of people are doing rolling the cash flow into the same or taking distributions? Is it 50-50, 80-20?
We're about 60 to 65% who reinvest their income back into additional shares. So we give that option to anybody. And so I just say, just the way it works right now, that about nearly 2/3 of our investors are not in need of income right now, and they reinvest, which is, it's an unbelievable thing when you look at, when you're getting the consistency, right? We've all heard of the power of compounding interest, right? A lot of us have probably run those calculations, right? But you do a 13% return, your money doubles in 6 years, right? It's pretty amazing when you're getting that kind of consistency. So the growth that happens with the consistent monthly distributions at those kind of returns are pretty amazing.
What's it been the average in multifamily funds? When would it double? If you put $1 million in today on average with your performance, it would double to $2 million when?
Historically, it'd be well under 5 years.
Excellent. Another question came in, has to do with the lending fund, the multifamily housing fund borrowing from your lending fund. Does that happen? And if so, what does that look like?
So it can happen, and for us, it's we think for everybody involved overall, it's a wonderful thing. Right? One of the great values we have is when we go in to buy a deal. A lot of the deals we buy because we can move fast, right? Let's just pretend you were selling a property and you had a buyer, and that buyer fell out a week before closing, and now you're buying another property, and you really need this sale to happen in 2 weeks, right? There's virtually, and of course I'm being slightly exaggerating, but there's virtually nobody who could close on buying a $30 million apartment community in 2 weeks, right? Because everybody needs to get a lender, and no lender can do it in 2 weeks virtually. We can, and we do, but the ability for us to control the entire capital stack, the ability for us when we go and make offers on deals, for us to be able to confidently say, yeah, we can close in 2 weeks or 3 weeks or 4 weeks, and we have 100% control of the capital, puts us in a position to get great deals. And if you're on the lending side of our business, if you don't think we're the lowest risk you could ever take per se in who the borrower is, right? You probably shouldn't invest with us, right? If you don't think we're going to be able to pay our interest payments, there's probably bigger problems on your investments with us, right? But fundamentally, we don't have much of the lending fund lent to properties we own, simply because generally speaking, we get a much lower cost of capital ultimately. So we'll use it as a tool when needed to close deals quick and so forth. And we fully disclose that. So on the lending reporting, that's what we're going to say, this loan is to a DLP affiliate, right? We fully disclose it. We lend at the same terms and conditions, but it just doesn't happen a huge amount of time just because we generally get much lower cost of capital.
Perfect. You ready for the lightning round? We're going to finish out.
All right, let's do it.
All right. Knowing what you know now, Don, if you go back to your 20-year-old self, what's the one golden nugget make sure to tell yourself to do?
I would hire even faster. I would hire and bring in great people faster.
Question number 2, what's the number one book you've recommended or gifted the most in the past year?
Sacred Marriage.
Question number 3, what's the number one leadership quote or theme that you strive to live by?
The one for the last year, I'd say, is many people have the will to win. Few have the will to prepare to win.
Love it. Next question. What are you most curious about right now?
I'm most curious about right now. I would say right now, full transparency is well, really where my biggest focus is right now, banking, because I'm about to buy a bank in 45 days. But I've been working on that for a few years now. But the other interesting thing that we're starting to explore is heavily self-storage.
Excellent. Last question. After all your success, helping all the people you've helped, building, DLP and being ultra successful, how do you stay centered on your values and stay encouraged to charge forward to reach new heights?
Yeah, that one's pretty simple, right? I believe that we all of us probably on this Zoom call here, right? We live in the greatest country on earth, at maybe the best time to be alive, with all the opportunities and advantages that you could ever imagine. And then each of us, was given a certain set, as you called them before, superpowers or blessings or gifts from the Lord. And so, everything I've accomplished isn't because I'm so great, it's because he's so great. So when you can put that in perspective and remind yourself of how little, I am in the scheme of things, and how little of an impact per se in my doing, things are done through me, and I get to be a piece to the greater puzzle, which is a great opportunity. And then, my family does a good job keeping me humble, reminding me, and that's my what I want to be remembered for is something we teach. And I start what I want to be remembered for is kind of thinking about living for a eulogy. I start off with, I want to be most famous in my own home, right? And my kids aren't that impressed with what I do at work, right? They're impressed with, the quality time I spend with them and the fun experiences we create. So that helps keep me nice and humble.
Amazing. Hey, Don, I want to thank you so much for sharing with us so much wisdom, perspective, nuance, details. I want to encourage you to keep using the gifts of being confident in your ability and the gifts you've been given to make a big difference in people's lives, to create and preserve more wealth, to make an impact in the housing crisis, and to have that deep conviction to succeed and help others succeed. So that being said, for people who want to get in touch with you directly, Don, would you mind one last time, what's the best place for them to find you?
Yeah, absolutely. So you can go to our website, dlpcapital.com, click investor portal, and see, all of our funds, quickly register. I think Larry dropped in the chat box as well his email address, which is larryh@dlpcapital.com. My email address is don@dlpcapital.com. Love the opportunity to connect with any of you for sure.
Amazing. Hey, I want to thank everyone for being a part of this special webinar with DLP Capital, our newest strategic alliance. And I want to remind everybody that, having a clear plan to invest and to exit, is so important, right? And the enemy is not having that plan and using something like the deferred sales trust to exit cryptocurrency businesses, real estate, primary homes, public or private stock, defer that tax and be able to invest at optimal timing, to be able to diversify and to invest with groups that have proven track records is an amazing way for you to create and preserve more wealth. If you want to learn more about the deferred sales trust and how you can get started today, you can go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. And again, remember the new book that's coming out, Building a Tax-Deferred Exit Strategy, and we call it the Proven Playbook for Unlocking Your Ideal Wealth Plan when selling assets of any kind for yourself or for your clients. Thank you so much. Please rate, review, subscribe. Please share this so someone can inspire today and encourage. And we'll talk to everybody again real soon. Bye, everybody.